Hey everyone, welcome to another deep dive. Today we're going to really try to crack the code on building a portfolio that actually, does something instead of just sitting there.
It's all about making those smart money moves, and we're going to equip you with some key insights from this finance textbook to help you do just that.
Yeah, we're talking risk, reward, diversification, all that good stuff to level up your investing game.
And don't worry, we're going to break it all down in plain English, even if you've never really, been a finance person. You'll walk away feeling confident about making smart decisions for your money.
Love that. Let's jump right in. The text really emphasizes this whole historical versus expected returns thing, which I think is a great place to start.
Right, super important to understand that difference. Just because something, like an investment, did well in the past.
Doesn't mean it's going to keep doing well.
Exactly. It's tempting to look at old charts and graphs and be like, oh, it went up before, it's got to go up again. But
It's not that simple. Not at all. Though the text does highlight some pretty interesting historical data points.
sure.
For example, did you know that U.S. large company stocks have actually trended upwards since 1926? And that's with all the ups and downs, crashes, recessions.
Wow. So even with those bumps in the road, the market
Still has that potential for growth over the long term.
So maybe taking that long-term perspective is key.
Definitely. It's
Right.
about weathering the storms
Yeah.
and understanding those fluctuations are normal, especially with equities.
Okay, that makes sense. But what about this idea that higher risk always equals higher reward? I feel like that's something you always hear, but the text seems to push back on that a bit.
Yeah, it's definitely more nuanced than that. I mean, riskier assets can mean bigger gains, but it's not a guarantee. Like you could climb Mount Everest,
And yeah, you get an amazing view,
bragging rights, the whole thing.
but it's definitely riskier than just taking a walk in the park.
Yeah, exactly.
Yeah.
Higher chance of things going wrong, right? So it's all about finding that balance between the potential reward and how much risk you're actually comfortable with.
Right. So how do we figure out what our own personal risk tolerance is?
Well, that's where the text dives into this idea utility, and this is where it starts getting really interesting for actually building a portfolio that, actually suits you.
Okay, let's unpack that. What do we mean by utility in this context?
So utility is basically like how much satisfaction you get from an investment, considering how much risk you're willing to stomach. Some people are totally fine with slow and steady growth, while others...
You want to see those big swings, those big wins.
Exactly. And to help visualize this, the text talks about indifference curves, which I know sounds intimidating.
Yeah, a little bit.
But it's actually pretty simple. Imagine a graph where each line shows you different combinations of risk and return that would basically make you equally happy as an investor.
So someone who's more risk averse, that line might be pretty flat, right? Not a lot of big jumps in return, but also
Not a lot of big drops either.
whereas someone who's comfortable with risk might have a steeper line showing they're willing to ride those waves a bit more.
Exactly. That's the key takeaway here. There's no one right answer. It all comes down to your own individual risk profile, right? And what you ultimately want to achieve with your money.
This is making me realize that building a portfolio is way more personal than I thought. It's not just about chasing the hot stocks. It's about
It's about you and understanding your own risk tolerance, which brings us to, this whole diversification thing. You probably heard it a million times, right? Don't put all your eggs in one basket.
Yeah. But the text kind of breaks down how that actually works, in practice with investing.
Totally. They have this example, right? A company called Beachwear. And as you can imagine, they only make money when it's sunny out.
So their profits are totally at the mercy of the weather.
Exactly. But imagine if they added something to their, business portfolio, something that does well when it rains, like they start renting out DVDs or something.
So it's about spreading your bets across different investments.
Yeah, investments that ideally perform well under different circumstances, And that's where this idea of correlation comes in, which the text talks about. Basically, how much do two assets move together?
And the lower the correlation, the better.
Generally, yeah. Lower correlation means you can potentially smooth out those bumps in your portfolio, if one thing's down, maybe the other thing is up.
I get it. So it's if you've got stocks, those might do well when the economy is booming, but then you might also want some bonds, right? Because those might do better if there's a slowdown.
You got it. It's like building this all-weather portfolio. But the text also talks about how diversification goes even deeper than just stocks versus bonds.
Yeah, it's not that simple, is it?
Nope. You can diversify within those categories too.
Yeah.
Even just with stocks. You've got different industries, different size companies.
Oh, no, right, right. And different countries too, even, right?
Exactly.
Yeah.
That's where things like index funds can be super helpful because you get that built-in diversification. You're not betting on just one single company.
So you're covered if, like, I don't know, the robot uprising happens and all tech stocks go down or something.
Something like that, yeah.
Yeah.
And speaking of, different countries, don't be afraid to look beyond your own borders for investment.
Yeah, go international.
It's all about, tapping into those opportunities around the world.
This is making me realize that the investing world is way bigger than, like, my usual little bubble.
Yeah.
Okay, so we've talked about diversification, but how do we actually figure out what our own, like, dream team portfolio should look like? That's where the optimal portfolio stuff comes in, right? So it's like assembling, like, a little team of all-star investments, each with their own.
I like that. Building that, like, dream team. It takes, strategy, planning, just like this optimal portfolio the text talks about.
Okay, so walk me through it. They start with this whole risk-free versus risky assets thing, but like...
And kind of misleading, right?
Yeah, because nothing's really risk-free, is it?
Exactly. There's always some risk, but I don't know, like government bonds. Those are usually considered pretty low risk.
Compared to, like, investing in my friend's new, what was it? Underwater basket weaving business.
Right, exactly.
Yeah.
So when we talk about risk-free, it's all relative.
Gotcha. But should we all just load up on government bonds then, if they're so safe?
Well, that's where this two-fund separation theorem thing comes in.
Oh, boy. Theorems. Here we go.
Don't worry, it sounds way more complicated than it is. It basically says your best portfolio, your ideal one, it's really just a mix of two things. A risk-free asset, like we talked about, and then an optimal portfolio of the riskier stuff.
Okay, so a little bit of both.
Exactly. You're diversifying between that super safe bet and then the stuff that, might have more potential for growth.
So someone closer to retirement, maybe they want more of that safe bet portion.
Right, exactly. Lower risk as you get closer to needing that money, while someone younger, with more time to, like, ride out the ups and downs, they might want more of the higher growth stuff.
This is making a lot more sense now, but earlier the text mentioned that, like, diversification isn't free? I mean, having all these different investments seems like it could get messy.
Oh, totally. That's a really important point. It can be costly too, right? All those trading fees and stuff. The key is finding a good balance.
Yeah.
You don't want to be so diversified that you're, like, overwhelmed.
Right, right. So how do we find that sweet spot?
Honestly. It's going to be a little different for everyone. It's about, how much time you have to spend on this stuff, how much you want to be involved. Some people, they love researching every single stock.
More power to them. But I'd rather, like, delegate that.
Exactly. And that's totally fine. There are robo-advisors, financial advisors, you name it.
Well, this deep dive has honestly been a game changer. I feel like I've graduated from, like, investing is scary to
I can totally do this.
almost. Okay, maybe I'm less intimidated by this now. Big thanks to our expert for, walking us through all this today.
Happy to do it. Really, the most important thing is just getting started.
Couldn't agree more. And to everyone listening, thanks for joining us on this deep dive into building your own optimal portfolio. We'll see you next time. Happy investing.